Hi, I'm Paul Ankers. I'm Director of Vantage Accounting, and today I'm answering common questions I'm asked about the tax year. The tax year runs from the 6th of April each year all the way to the 5th of April each year. We get asked lots of weird and wonderful questions. I often say to clients there's no such thing as a stupid question. The more you understand, ultimately our life becomes better and we can work better together. A couple of common questions we get asked are, is there anything I need to do? Okay, and do I owe any tax on the 5th of April? So first one, is there anything you need to do? Ultimately, at the 5th of April, there isn't anything you need to do. What you want to do is look before the 5th of April and say, okay, have I made use of any allowances? Have I looked at things like pensions, charitable contributions, things like that? In terms of do you owe any tax on the 5th of April? No, is the answer. You owe the tax the following 31st of January. Now, there is something called payments on account as well, where you look at paying in advance, which we can look at separately, or if you have any questions, contact us. But on the 5th of April, no. The way we often advise clients and speak to them is about putting the tax aside as you go along. So rather than wait till we do the tax return, send it to you, you look at it and that's the first idea you're getting of what your tax bill is. We'd much rather work with you so you know how much to pay. So for example, if you're anticipating a tax bill of £5,000, that you go ahead and put £5,000 aside throughout the tax year. There are a few things that I would make sure that you claim as a limited company director. For example, trivial benefits. A trivial benefit is a gift from the limited company to yourself as an individual up to the value of £50 each, and you can do that 6 times per year. The gifts can't be grouped together, so as an example, you couldn't turn around and say, I'll go and buy a £280 gift and that's my total of £300 for the year. Each one has to be up to the value of £50. That could be anything from chocolates and flowers right through to a £50 gift voucher. If you have any employees, this applies to them as well, but there is no restriction to the number of gifts for the employees, but it's important that it's not related to their service. So i.e. you cannot turn around and say, rather than give you a £1,000 bonus for hitting your targets this month, instead here's 20 £50 gift vouchers. Okay, you can't do that. Next thing that I would ensure you claim is making sure you've made use of the annual staff party. There's detailed rules on this, okay, so I would suggest you get in touch with your client director and they can talk you through it, but it's something that's nice to have. And that is something that I would think of a lot of these tax rules are. They're nice things to add on. I appreciate that the trivial benefits on their own or the annual party are not suddenly going to change your life, but they are nice things to have. So, firstly, ensure that you've actually declared all the dividends you wanted to in that tax year. You cannot backdate a dividend, so you want to ensure that as at the 5th of April, you've looked at your available profits in the company, and they build up over time, so they're called retained earnings, and you decide what dividends you're actually going to take. Now, a lot of people try and restrict themselves to £50,270 total income each year. That includes all income, including salary, bank interest, rental income, etc. If you're not sure what your total income is and you want some assistance in planning for that, give us a call. We can talk you through it, work out what we believe your income is, and then let you know what you think you've got left off your basic rate band. The reason people go for this limit, effectively, is that's the traditional basic rate tax band. Tax rate on dividends in that band is 8.75%, and above that it jumps to 33.75. What you really want to avoid, if possible, is doing 20 one year, then 80 the next, then 20, then 80. You're better off just doing that 50 each year. But obviously I appreciate you need the money to do that, you need the profits to do that, etc. The other thing I would make sure that you do as a limited company business owner is use your dividend allowance. Each year, you can receive £500 per year of dividends, okay, and it's taxed at 0% rate. So the important thing to remember here is it's taxed at 0% rather than tax-free. So tax-free would imply it doesn't even touch your tax return, and it doesn't affect any allowances or anything like that. Taxed at a 0% rate means it goes onto your tax return, but it doesn't actually generate a tax bill from it. So what that means is if you earn over £100,000 per year and you're losing your personal allowance, and that's at a rate of £1 loss in your personal allowance for every £2 of earnings, the £500 dividends will still count as income. So even though it's taxed at a 0% rate, you're still going to lose your personal allowance. So if you fall into the category of earning over 100 and you've still got something left of your personal allowance and you're not sure how the £500 dividend allowance would affect it, just give us a call and we'll talk you through it. So as a limited company business owner, one thing that you often will look at will be pension contributions. The company can contribute to an employer pension scheme up to the value of £60,000 per annum. Now there's a few caveats to that. Okay, so it's got to be related to your service, so you've got to be an employee. The next thing is it's got to be from available profits. So if you're loss making, but you just so happen to have money in the business, you can't use that to make a pension contribution. The next thing is if you've got previous year unused allowances, my suggestion would be to speak to a financial advisor, because it may be that you can actually contribute more than the 60,000 because you're using the current year allowance and previous year allowances. The big advantage to making a pension contribution directly from the limited company, so as an employer contribution, is that it's a business expense. A great scenario would be that at the end of the year, you're looking at your profits and you make a pension contribution of £60,000. Now, that could save a business owner typically around £15,000 per year in corporation tax. The common argument is it's costing the business, say, £45,000 to have £60,000 end up in your pension pot. If you're an individual, okay, or a self-employed business, then pension contributions can still be made, but they're treated very different to a limited company pension contribution. Instead of it being an employer contribution, these are now personal pension contributions. So if, for example, you made an £8,000 personal pension contribution, that's coming out your personal money, okay? So it's not a business expense, so you're not going to get tax relief on your self-employed profits, for example. What happens with that 8,000 is it will get grossed up in your pension pot to 10,000 by the government. The £10,000 is your gross pension contribution, and that will extend your basic rate band. So I appreciate I'm talking technical terms here and things like that. So for ease, the basic rate band is where you pay 20% tax, and that threshold goes all the way to £50,270 per year. If you had made that £8,000 contribution, so 10,000 gross, your 20% band, so that basic rate band, goes all the way to 60,270. So if for ease your employment income was £60,270 per year, that £8,000 pension contribution would have swapped your 40% tax on that extra 10,000 for 20% tax. So your £8,000 net contribution ends up being 10,000 in the pension pot, but really it's cost you 6,000 to get there, okay? Being the 8 you made and the 2 you save in tax. So another thing to consider each tax year is your charitable contributions. So as an accountant, when I do tax returns, I would say it's probably one of the most common things that's left off. I'm sure many of you have contributed to charity. You fill in a form and you tick a box that says gift aid. Okay, now that gift aid box effectively means that the charity receives more money. Okay, and for a lot of people, that's all they really know. Well, what's actually happening, okay, is on your personal tax return, you record that you're a taxpayer, okay, and that you've made those contributions. And as long as you haven't, contributed more than the tax you've paid, that's the end of it in terms of the tax side. But a bit like with pension contributions, you get an extension of your basic rate band. So the one thing to be careful of is when you do tick that box for gift aid, you are effectively confirming that you are a taxpayer. So if any of you just live on your, let's say, savings and a £500 per month salary, for example, and at the end of the year, your tax return just says £6,000 of income, you're not paying any tax. So if you've then told me that you're making charitable contributions and that you've claimed gift aid on those, because the charity will effectively be getting extra in its pot from the gift aid, you actually end up getting a small tax bill for that value of gift aid. So it's a strange one. You don't see it much, but something to be careful for. What I would say is every individual and every business has different circumstances. Whilst generalised comments can be useful, I do think it's best if you have any questions, contact your client director and they can actually give you advice on what you can claim in relation to your actual business activities.